What's up, everybody? Michael Silva here. Happy New Year. We're in 2023, the first video of the year. But let me tell you something. We have the same storm taking place. It's a new year, same storm. We got a lot to talk about on today's stock market brief, so we're going to go ahead and get right into it. Welcome back, everybody, to the Stock Market Brief Show. S&P 500 was down a whopping 19.44% on the yearly candle, wiping almost all of 2021's gains away, unfortunately. And we're gonna dive into some interesting charts today, and then we're gonna get into volatility and how we can kind of adjust portfolios and how to actually tactically go about that. Yep. Wild ride in 2022. Year to date, the big outperformance came from energy sector, up 64%. Now look at the next three up on the rankings. Remember, year to date, 11 sectors that make up the S&P 500. Utilities, consumer staples, healthcare. What do they have in common? They are defensive sectors. So going into 2023, it's going to be important to keep an eye on these defensive sectors, because if they remain defensive and doing quite well from a relative standpoint, it could bring the market into continued jeopardy, which we have constantly seen. We've seen sectors like XLY get completely crushed. Thank you, Tesla. XLC, communication services, get completely crushed. Big names like Verizon, AT&T got absolutely crushed. We'll see a heat map here momentarily. The Nasdaq Composite was down 33%. Look at this yearly candle. What a whopping monster candle to the downside, cracking well below the yearly low from 2021. So this does look, and we closed pretty much right on the lows, like it could potentially further reach down at some point. So it's always important to look at these big levels. Like imagine if it came down to 9,000, where it was the prior high here and the close over here. That could act as a level as potential support. But like I said, we'll see. We got to zoom into the smaller time frames as well. Now, if you take a look, what brought down the composite? What brought down the S&P 500? Things like Amazon was down 50%. Tesla got whacked. Apple got whacked just more recently, right? Google down 40%. Meta, I think it was down around 65%. Microsoft down 28%. These big squares mean that they're the bigger market cap names. And the bigger market cap names have more weighting in these cap-weighted industries or index products. Take a look at IWM. It was down 20.48%, coming off of its low. But remember what I said about coming down to a potential high right here and then a closing right here. Well, it did that actually in the Russell, and we bounced from those levels. So back to the composite, if it came down to this closing high over here, and then also potentially this open, that could potentially act as a bouncing point. That was for the SPX. I meant the composite, but the composite was the same thing. Okay, so let's move on forward. ARK. This is like the mother of the bubble besides Tesla, right? Up and away, made Kathy Wood completely and utterly famous on TV every single day. This year alone, it was down 70%, but that's, not compared to where it actually was, where we tapped out around 160. So this thing got absolutely and utterly crushed, and we're closing pretty much right by the low of the year. So wild ride there. Dow Jones Industrials was only down 8.78%. So this could be one to watch too as well. This is well off the low, right? So where did we come into? Well, we came into this close over here, and we came into this prior high. That level acted as area of support right around 29,000, and we started bouncing up from that level. Now, why is it the same storm? That's going to be the important piece to understand. The same storm is because the Fed is doing the same exact thing that they said that they were going to be doing. They're going to continue tightening until that changes, right? Until we see change, they are tightening. So this right here is their total assets, their balance sheet, right? We're tapering off. And when it tapers like this, it makes illiquid markets, and the markets become just a lot more volatile. Now, what else are they doing? Well, they're raising rates, right? These rates that we've recently hit is the highest we've seen since 2007, entering into a recession. Now, there's a lot of talk about a pause and then a pivot, which if you look at charts, sometimes that's not a great thing for the overall markets, which could create another leg down. So we need to be prepared for things like that to happen. As it stands right now, I don't have, the Fed watch tool wasn't loading properly, but when I did see it, it looks like there's another 25 basis point hike in February, another one the following meeting, and then it kind of like slows off right there until September or something. And this was like the current probabilities. It tapered off by like a 25 basis point. So if that's actually the case, if they actually continue to raise rates like this and taper, and we've already seen this massive amount of volatility, it could be a wild start to the year, because there's going to be a lot of macro data drops, and the market is very data dependent, as we have seen. What else has happened this year? Well, mortgage rates, right? boom, they shot up like absolute crazy. We haven't seen a rate of change like that pretty much forever. So back up to a very, very high level. They came off slightly, but we're right around 6.42% on that. We also saw the copper to gold ratio get absolutely crushed. Now, this is an important one because, copper, Dr. Copper, right? That's how good the economy is doing. So when line is going up, typically that's a good sign. Gold is more of a defensive. You go there for safety, hedging against inflation, which, didn't work out all too well for hedging against inflation this year. It didn't go way up, but it didn't go way down, which was nice. Now, when this goes down, as we've seen prior, this actually tracks very well and gives us sometimes insight into United States ISM Purchase Manufacturer, the PMI. And why am I saying this? Well, look at the chart, okay? This is a 10-year chart, right? Boom, 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 boom. Boom, boom. So that's copper to gold ratio. That's the PMI. Copper to gold, PMI. Copper to gold, PMI. See, notice that they track pretty darn well. So I think that potentially this has room to go lower, which means what? Copper could underperform gold, which means gold could be a potential good investment going into this year. If that is actually the case, you can see here we moved into contractionary. We got under 50 on the PMI. So, contraction. What else do we got going on? Well, we have massive inversions in the 10 and 2. It's coming up a little bit there, but we're still 53 basis points inverted, 54 basis points inverted from the 10 and 3. And these are excellent indicators for potential recessions up ahead. They, have a great record for monitoring that. Speaking of recession, well, Wall Street Journal is reporting now they're pulling out the recession card. They're talking about big banks are predicting recessions and a potential Fed pivot in 2023. Okay? In that article, there's a number of red flags. They said Americans are spending down their pandemic savings, the housing market is in decline, and, which is true, banks are tightening their lending standards. So, what can amplify this type of stuff? Well, and by the way, where was it? Yeah, spending down their pandemic savings. When you look at savings rate, actually, personal savings rate, it is near an all-time low, which is not a good thing. Now, the thing that could amplify this is the unemployment rate. The unemployment rate's still relatively low. So if this thing starts spiking, there's a lot of problems that can amplify here. And, there's something I was going through Costco today, and I noticed that these kiosks, right? These kiosks, they're known as wireless advocates. That they're an agent that sells T-Mobile, AT&T, Verizon. I'm well aware because I've worked for Verizon for 13 years, so I'm well aware of agents that sell our product. I had to overlook sometimes these types of places from the corporate perspective. Now, I found out just recently they had announced that all employees are being laid off and the company was shutting down its operations. They've been in business for 18 years, and they've been a pretty good kiosk from my understanding from the numbers that I look as far as business perspective. Well, they have 700 locations nationwide. That's 1,500 employees that are going to be getting laid off. Now, to be quite honest, I'm well aware that this could happen more frequently in the communications industry because I came from there. I even 3 months ago was posting on LinkedIn saying cell phone stores are eventually going to be the next Blockbuster. To be honest, in my opinion, there's really no need for cell phone stores all that much because most of the times now people just order their stuff online. And at the cell phone stores, they used to set it up. They used to transfer contacts. They used to move everything over. But now that has become so streamlined by technology, really who benefits from going to these cell phone stores? Typically, it's the company itself. And there's a wide margin there. So now I'm going on a rant, but just add that to the list of company layoffs in 2022. Some recent ones, right? Cisco, Goldman Sachs, we had DoorDash, we had Amazon, Meta, Twitter, right? Some big tech layoffs. We knew about Peloton, and here's a list. I don't know if it's fully updated at this particular point in time, but yeah, just some massive layoffs. So to see unemployment potentially uptick here in the near future could be a big possibility. So be careful there. How do we really manage this from a trading perspective, right? This is a lot of data dumping, like narratives and whatever the case is. Well, take a look at the VIX. Now, the VIX has been around this 20 region pretty much since 2020. And we know this because we've seen lots of massive volatility. Now, when the VIX goes up, I want people to understand that doesn't mean that necessarily the S&P 500 has to fall down, right? They call this the fear index, right? And people obviously they think it's the fear index because when it goes up, prices go way down. Well, typically, in my opinion, why they call it the fear index is because it's fearful when this goes up because for portfolio managers, they're not typically short-term traders. When volatility goes up, it's good for short-term traders. But if you're a portfolio manager and volatility increases, and say you're 100% exposed to the market and volatility doubles, well, guess what? That 100% that you're exposed now can have, double the amount of swings on a daily basis from a percentage base. So when I look at this and why we think that the volatility storm is going to be continuing into 2023 and how you can really prepare yourself for that, I think that we have to look at something like this, right? I'm not going to go over into the math, and you can even break this down into a daily percentage. But so the VIX closed at 21.67. Okay, and if we look at this, we look at 21 or 22. What does that tell us? It tells us that the S&P 500 on 30 days, plus or minus, it can go up or down around 6%. Those are huge swings in the S&P 500. So we need to be well aware that, hey, when volatility goes up, our position sizing and how we position ourselves, if you look at like standard deviations, I always look at weekly expected moves and so forth, which we'll go over. Your position sizing, right? You might become more of a shorter term trader in higher volatility, which I've been doing a lot more of here in 2022, intraday trading, because volatility has been increased, which tells me that, hey, maybe you might spend 1 to 5 days on a swing trade or a day trade versus holding things for 1 to 3 months time, when you typically go through periods of obviously lower volatility, right? That's a lot easier to manage in the investable bucket, but when it gets more up into these ranges, that is when things get a little bit more complicated. But it's not just VIX, okay? Take a look at VXN. VXN is NASDAQ volatility. This is in the mid 20s, right? We closed at 27.6. So yes, we've seen massive swings. And remember, that doesn't mean that the market can't go up, right? This is plus or minus. Remember that, plus or minus. When we looked at 21, 22 over here, it can go up 6% or down 6%, which is volatile, right? That's volatility right there. RVX Russell volatility closed at 25.07. So volatility is here. It hasn't abated by any means. Now, we know that when there's data drops, when the Fed speaks, the market reacts, and it reacts violently, upside or downside. Now, going into next week, going into the new year of trade, we have a lot of data coming out this next week. We got here, right at pretty much just after market open. This is, like based on trend trading economics. It's rated 2 stars of a report of importance. The red ones are the major reports. So those are going to be ones to watch as well. But you got global manufacturing PMI, you got ISM, it's a PMI over here. You got JOLTS, that's going to be important. You got FOMC minutes, which, by the way, I mean, a lot of these might not typically move markets, but in today's world, they have been. You got balance of trade, you got non-farm payrolls. That's going to be a big one. That's at the end of the week right there on Friday. Then you have ISM, non-manufacturing PMI there too as well. That's going to be a major report to keep an eye on. How's the market pricing this in so far? Well, the S&P 500, SPX, and the SPY is right below it. We're looking at a plus or minus $84 move. Okay, now these last weeks, where did we go? Well, if I take a look at the SPY, we have not gone anywhere from a week-to-date perspective, actually. We closed basically unchanged, and we've closed basically unchanged now for 2 weeks. So this is not a bad sign, but let's go back over here and screenshot this if you want to see what the other expected moves are for the Qs, IWM, and DI. These are the upper ranges. These are the lower ranges. If you don't know what the expected move is, I have a video linked in the description that tells you. Basically, it's saying, 68% of the time, 68, let me draw this out, 68, and by the way, for the S&P 100, I'll tell you here in a moment, 68% of the time, price closes within these ranges, okay? 68% of the time, based off these expected moves, based off implied volatility. Now, the SPX actually has a higher percentage. It's more north towards around high 79 to 80% of the time that it closes within the expected moves. And this year has been known as the 2 standard deviation year because it's been closing almost 2 standard deviations outside of it multiple times. Now let's hop back into the 15-minute time frames. Where have we gone these last couple of weeks, right? Pretty much nowhere. We've been going sideways in this chop box. Now, a couple areas that I want to pay very close attention to going into next week is this Fed anchored VWAP. You can see we talked about on the last video, we came up to it, we gapped down, we couldn't get through it, we gapped down, we couldn't get through it. So if we start getting above this line, this anchored VWAP, I think that opens the door to head higher. Okay, but as it stands now, from a good basis, we are starting to see the 5-day moving average flatten out, which we kind of said would take time. And as you can see, we're fairly basing out right here, right? We could be putting in a diamond bottom perhaps, but we'll see where the market wants to open up. I know we gapped up in the after-hour session. Now we're selling off. Now we're in the red, but futures, it could look all funky. It's just wait until open, and we'll kind of go from that point. From the downside, if we start cracking down, look at 373.92 for the SPY on the downside. So overall, we are building a base. Okay, it could be a diamond bottom pattern, but it could also be a bear flag. Right now, it's consolidation. What does that mean? It means that I'm not going to be bullish until we can get above that anchored VWAP, until we can hold this purple line, which is the 5-day moving average on an intraday time frame. Okay, intraday time frame meaning on the 15-minute time frame, I use the 130 period moving average. One of the tricks and tools that I got into my tool belt from Brian Shannon from Alpha Trends. Take a look at the Qs. The Qs here, upper edge is 274, lower 259. Where have we gone all week? Oh my gosh, we're not even making moves, right? So you can see we gapped down from this area, and then we kind of got back above that 5-day moving average. When we did, we saw a nice big explosive move to fill that gap. So where can we feel a little bit more confident getting above? Well, first and foremost, we'd want to get above this area, this neckline, which could be potential, boom, inverse head and shoulders. That could take us right up to that 274 marker. Be mindful of this anchored VWAP right here. This anchored VWAP is the anchored to when the Fed talked. This anchored VWAP is actually December, the start of December. So that's going to be an interesting one to watch too. Back if I go to the SPY, that anchored month to date VWAP is actually right there currently at the upper weekly expected move. So you have the upper weekly expected move on this end. You have the month to date anchored VWAP. So if we get above that, it might be an area to say, hey, I might take off some profits if you entered right here, see how it trades around. Maybe it flags. Maybe it just comes right back off and it just tricks everybody and we stay in this range, right? There's multiple things that could potentially happen, but we got to prepare ourselves for what can take place. And the way that I do that is by looking right here, saying, hey, if it gets above that, I'm a little bit more bullish. Start to see the 5-day moving average come up. Maybe we go boom, 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 something like that, okay? Now, if we take a look at the last one that I want to look at, it's the IWM. The IWM is right there on that Fed anchored VWAP, and it's really not going anywhere for a couple of weeks as well. So this could very well be a bottoming pattern. It could be just another chop box. It could be a range, right? So what we need to see as this open interest is just building up in here, we need to start seeing it break some key levels. This is the anchored VWAP, obviously around 178. That's for the start of December anchored VWAP. So if it comes up here, up into these areas, just be prepared that, hey, it might need to take a break, right? So now it might do something really slow. That would be a bullish sign, right? But a strong move, you watch out for the strong moves, right? You always want to see how it got there. Strong moves have been getting faded. Strong moves, they've been getting faded. Strong moves, they've been getting faded. That's what happens in the chop box. From a good point, we had the 5-day moving average flattening out here too. So all three products, the SPY, the Qs, not as much, but it's starting to flatten out, and the IWM, they're flattening out. Now, IWM, small caps, these could sometimes lead. So if we start to see these move, it might be a good sign for the other index products too as well. So that's what I'm looking at going into next week. A lot of things going on. We'll go more into details, obviously, as more data comes through. Hope that helps out everybody. Happy New Year, and thanks again for all the support in 2022. See you later.